Hello and good evening. Welcome to the June edition of our E.M.I Economy Markets and Investments presentation. This month, the focus of my presentation is going to be a little bit on outside of India because according to me and our fund house, the key factors impacting the market in the coming months are essentially going to take place outside of India. It is not that within India is without relevance, but I shall bring it in wherever necessary. But like I said, the clear focus is what's happening around us. So let me start my presentation. Starting with India, of course, this is the second wave, which was the biggest concern for all of us in the run-up in the last few months. And as we know, just before the second wave, a V-shaped recovery was well on track. We have shown the quarterly actual absolute real GDP, not the GDP growth rates. And as you can see, after falling, the GDP has been showing a V-shaped recovery when the second wave struck, right? And what did the second wave do? First of all, you look at the GST collection. I'm going to just show a few indicators to give you the trend. The GST connections, which was rising well above to almost 1.4 lakh crore, dropped back to the 1 lakh crore mark, sign of moderation. Next was the government's own procurement, which takes place through e-way bills, clearly saw a sharp deceleration. Third is that the PMI, which is a good predictor of future GDP growth, again, after crossing 50, both the services and manufacturing kind of stabilized and tapered down a little in the month of May, right? And classically, in terms of the freight movement and the passenger vehicle movement, because lots of states had initiated lockdowns, you saw there was a 17% drop in petrol and diesel consumption on a 2-year CAGR basis, right? And another reason why the second wave hurt all of these numbers was because of the poor progress that we had made then on the vaccination front. And as of 30th May, we had only covered 17% of our adult population, and only 5% of the adult was fully vaccinated. So effectively, you left 83% of the adult population, exposed to the thing in terms of, so that's why you saw the number of hospitalizations, number of deaths, all of them become cause for worry. If you take an overall population, I've given the number below. It's about 10% of population for one dose and about 3% for both the doses, right? So why was this second wave expected to have a significant impact? Because where the second wave hit was actually the top GDP contributing states. So if you look at Maharashtra, UP, Karnataka, Gujarat, and Tamil Nadu later, they account for almost half of our GDP. Naturally, that's why the original expectation of a double-digit GDP growth of 11.5 to 12% had to be tempered down by market participants to well below 10. As you will see, RBI has come out with 9.5, and several foreign Moody's have again made it sub 10, right? But the good news, which is captured here itself, is that the second wave effect has already started turning negative, implying that by the end of June, right now, we should see start of resumptions of activity. I will show you a slide to show that is actually happening. So based on that, if you see the growth rate V-shaped recovery, right, and in dotted lines is what we expect, is that there will be a tempering down. Now, we are not exactly tempered it, but you can expect that this V-shape is going to flatten out a bit. How will we know how much to flatten? First of all, we'll have to wait for the quarter 4 numbers to know the extent of activity moderation. Then you'll have to also see state by state how widespread the lockdowns were. And you also then have to factor that a drop in this quarter could very well lead to a rise in the next quarter, because the pent-up demand of what actually happens in these months could all come together in the festival season post Diwali. So these are the factors to take into account in projecting the GDP growth. And as I said, business resumption, right, has continued to rise. So you saw that the previous crisis last year, it had come down to 45 as an index, came back all the way to 99, which means almost pre-COVID level. The second wave effect started killing it, and it came down to 60%. But as you can see, rapidly the second wave effect has been taken control, and it's back close to 81%. There's still 20% more to go to come back to pre-COVID levels, but at least there is a V shape forming, which means we have reasonably controlled the second wave impact. Right. Now, what about the third wave? They say guaranteed a third wave is coming. But the good news is that we have subsequently stepped up the vaccination progress, because we have allowed the import and manufacture of Sputnik. We are allowing the import of other Johnson and Johnson and Pfizer. We've stopped export of our vaccines. So all of this put together means that the vaccination has picked up. And as per our estimate, even if you continue with the existing rate, by about April next year, you would have seen the 70% of population controlled and covered. But we expect that the government should be able to double the rate of vaccination because of the absence of exports and allowing of imports, which means that November 21 on a best case scenario, but give it a month or two, maybe by definitely end of calendar year, we should be able to get 70% of population covered. What does this mean? This means that you build a herd immunity. You mean that people who get vaccinated get COVID, it is not so severe. They probably take a week, 2 weeks off work, then come back to work in a reduced way. So these are all good things in terms of a third wave and its impact. So the knowledge that a third wave is coming itself is half the job. The second is that vaccination should help us to control it. So overall, the news on the domestic economy is definitely getting better. Now, in addition to this, one must not forget that whatever bad news on the economy, whatever happens, one consistent supporter to the government of India and helping our growth has been the Reserve Bank of India. They have expanded their balance sheet by 30% to counter it and have supported massive rate cuts to happen. On new loans, of course, you can see the blue line, the rate cuts have been tremendous. But even on existing loans, there has been a passing on of the rate cuts of RBI to the consumer. So overall, this is something that's definitely going to support the economic recovery, availability of liquidity and availability of cheap money. So with that, we have laid the base for the Indian story. And now, right, we move to the globe, right? Why do we move to the globe? Because the first thing is, you've got to remember that the global response to COVID was a massive monetary stimulus, because you saw that almost, if you take the G4 central banks, that is the top four regions of the world, US, Europe, UK, and Japan, you will see that $13 trillion, that is 30% of their GDP, has been floated out as liquidity, which has leaked out and come to markets worldwide. And the expectation is that by December 22, 29 trillion, double of this will be. So the expectation of the market was about $40 trillion of liquidity from the crisis beginning to end December 22 who's going to be there. So this is what has impacted stock markets worldwide and driven what we are going to see, right? In addition to this, there was also a fiscal global response. So monetary response is one thing. Both of these put together are the factors that are very important to us. So please listen to me carefully. The fiscal stimulus, if you see pre-COVID versus post-COVID, you can see the massive rise in the global fiscal impulse, and especially countries like US, the blue one. The largest fiscal stimulus was given by the US, followed by the red was China, which is why China recovered the fastest. And then you have the Eurozone in green. So the advanced countries' fiscal impulse, right, is very critical. Why? Because what this meant was that I've just taken one currency as an example, right? When their deficits rise, and here we have taken the twin deficit, so fiscal deficit with current account deficit, when they rise, their currency weakens. I've shown the dollar here because of the US. And as you can see, when you plot the current account and fiscal deficit with the dollar, whenever the fiscal deficits widen, the dollar weakens. So please remember this fact. Dollar weakens at every sign of rising twin deficits. Why was this so important for the past, and why is this so important for the future? The single most important thing to track is this. So when we now moved on, because when the dollar weakens and is supported by a massive monetary stimulus, you see that money flows out of the advanced countries where the stimulus is given into where emerging markets. So here the red line is the dollar index, the same line that we saw versus the current account and fiscal deficits. And the blue line is Bloomberg's emerging market capital flow proxy. They put together and arrive at this proxy, which tells you how much money is flowing to emerging markets. As you can see, when the dollar strengthens, money flows out of emerging markets. When the dollar weakens, money goes into emerging markets. So can you clearly see the thing? And you may be worrying why the dollar index is rising. It's an inverted graph so that you can see the shape very, very clearly, right? So this has meant that the monetary stimulus plus fiscal stimulus with a weak dollar, that money. And why does this happen? What is the logic? The logic is that the cheap money is available in their country. They don't want to invest in their country because the liquidity has brought the interest rates down. One. Two is that when the dollar weakens, the emerging market countries strengthens. So what happens is that not only get the higher growth rate of the emerging market stock markets, they also get a double whammy in terms of the currency appreciation as a return to their money. So this is the reason why this follows this, right? So the weakening of the dollar has been a key story on why emerging markets have got money. And which emerging markets have got money? I've taken a sample here. I just want to point out that the key here is what? I've taken the first row here is Jan, Feb, March 2020, just pre-COVID. All the emerging markets had an outflow, including India. So already the news flow about emerging markets negative growth pre-COVID was hurting the flows for India also. But the moment COVID crisis occurred, the negative flows to other emerging countries continued, but only for India it changed. Right? What is the reason? Because since then is when the dollar weakening, but despite that, other emerging countries like us did not get the kind of money we got. We got a lion's share of it. Now, what is the story behind this? Yes, India's growth story, all that we all know. Yes, but more importantly, right, when the crisis hit, in addition to the dollar weakening, there is one more story which is playing out. What is that story? It is the commodity price decline story. Commodity, because when dual demand collapsed, naturally oil price collapsed to $40, metals price collapsed, every commodity price came down except gold. So what was the reason for this? The reason was lack of demand. All the manufacturing input. Gold rose because it's a safe haven. It is not used in any industrial production. So India, however, got money. Why? Because we import 80% of our oil. We import a huge amount of commodities. So when commodity prices drop, the country which benefits is the one which uses commodities and doesn't export commodities. So that is a third factor. So liquidity is one factor, wicked dollar weakening is the second factor. The third factor is commodity price decline helped FIS to choose India as the favored country for putting their money, because Indian companies EPS would benefit from the input cost. The imported prices coming down would mean inflation will be low, so RBI will continue to support the growth. So overall, the stock market was in a sweet spot. So they put more money and it became a virtuous cycle. Because they put more money, the prices rose. So their act of putting money itself made the prices rise. So why I'm pointing this out is the context of this history is very, very important to judge the future. Right? So in that context of the history, see what has happened to because of these flows. Yes, the US stock markets also benefited from the liquidity. So about 40% rise from March 31 to June 21. But you look at the overall scenario, which is the countries whose stock market has delivered the best return to the FIIs? It's India. MSCI India has grown 81%. So all that money that came, it also helped the returns, but it also helped them make the best returns possible. That's why India was a favored destination for so long, right? Now, at this time, do not forget that we must remember what mutual funds were doing, right? During this period, in the first quarter of last year, pre-COVID, FIS was selling, as I showed. The numbers here are different because they are rupees crores, that was dollar billion, okay? 48,000 crores FI sold, but 40,000 crores MFs bought in that quarter one of last year's first quarter, Jan, Feb, March. But subsequent to that, as FIS continued pouring money green into India every quarter, mutual funds consistently sold. So FIS came, what do FIS buy? They buy large caps gold. But what did mutual funds sell? They sold large caps because they can only sell what there is a buyer for. So the rise in the large caps would have been much higher if MFs had been buying also. But unfortunately, because they were facing net redemption from their customers, and because they did not share the same optimism about India as FIS did, right? Mutual funds were right net sellers right through that period, right? Why I point this out is that then in this quarter, April, May, June, what are you seeing? Not only the FII flow has continued, albeit at a smaller level than the previous quarters, but Indian mutual funds have turned net buyers. That's also important to remember, because now Indian mutual funds are buyers because A, they are getting flows from customers, B, they are also seeing that the second wave is being controlled and we can expect a bounce back. The third thing is a lot of Indians, through the opening of demat account folios, have started directly investing in the stock market. You know the number of demat accounts opened. These investors are called Robinhood investors, and they've been buying largely broker recommendations. So small cap stocks, mid cap stocks. So overall, the Indian market, if you see, buoyed by FII buying, the large cap index has gone up 80% since the COVID drop. But the mid cap has gone up about 107 to 119, depending on which index you see, and the small cap has gone up 140%, right? So today we are sitting in that kind of a spot. Now you must be wondering, FII flows are so huge, and Robinhood investors and mutual fund flows are nothing compared to that. Why is that these stocks, these indices have shown that much better return than large caps? The answer lies very simple: the amount of liquidity in each stock available. Large cap companies are widely held. FII buying, mutual fund selling can all be absorbed because of the large amount of floating stock, as they call it, free float. Whereas in mid caps and to a much larger extent small caps, the free float is very, very less. 60 to 65% of small cap stocks, the promoters or large institutions hold the portfolio, and that is not available for sale. What is available for sale is only the public holding, which is at max 20 to 30%. The reason I say, and this is 20 to 30% of a much smaller market cap. So even somebody buying 10,000 shares makes the price goes up. So the starvation of the liquidity in the stocks itself means that even a small amount of buying in the small caps leads to a large price increase, right? So pause this thought in mind when we now move forward, because what am I moving to is that clearly domestic investors are investing because they see a sharp V-shaped recovery in the, this is the Nifty EPS, in the earnings of India. So the market is actually, with this growth, predicting a virtuous economic cycle, right? Can you see from 540 EPS for the Nifty for 2021 to 871 in 22-23. This V-shaped recovery is what even FIs are seeing and domestic investors are seeing. The same way they are seeing this in all the indices. So overall, if you see the indices, as you can see, I've taken from 2003, you can see the three indices: large cap, mid cap, small cap, rise, fall, rise, fall, rise, fall, and again now rise. So when you then split it, you can see that all the three have been rising at the end, as we saw from the returns post-COVID. But what I want to point out is that this thing goes in cycles. So why I'm pointing this out is in terms of the fact that when you take the same period and split it into 5 phases, phase 1 being a very good phase, April 2003 to 8, then a bad phase, global financial crisis, then the Mr. Modi phase, when he just came to power, we had a bull run, and then we had the crisis, right? DHFL, ILFS, negative inflation on the rural side led to the slowdown, finally with the COVID lockdown happening last March. And then from then you're seeing the recovery. So that's what I'm saying. The markets are now begin to predict a virtuous recovery. And this difference between the large cap, mid cap and small cap indices, though the difference is there, just look at the phase 1. That will give you a sense that if a true virtuous economic cycle is happening, then your small cap gives 3 times the returns of the large cap, and the mid cap gives double the return of the large cap. We are nowhere near that kind of a difference. So while the market is predicting a virtuous economic cycle, when this economic cycle actually comes through, the difference in returns between the three will be tremendous. The point is, when is that going to happen, and is there a risk in happening that? So that's where we turn our thought now to the valuations. I showed you the Nifty EPS growth expectations. That means the 1 year forward P's, if you take a graph. This is not the index graph, this is the index PE graph. Now when you see, and the dotted line is the long-term average, right? And where was the previous peak? November, December 2017. Can you see there? All the three indices had reached their peak in December 17. Then there is a fall in valuations. Then there is a rise. And what can you see from the black dotted line? The black dotted line represents the Nifty. The Nifty has gone above the previous peak. And what can you see about the small cap index? It has gone way above the previous peak, right? Can you see there? Almost there, and way above the long-term average, sorry. And the blue line is the mid cap, right? Which is still below the previous peak, if you can see that line, right? So to see this actual fact in numbers, I've put the same thing down in numbers. In December 17, the Nifty 1 year forward P was 18. Today it is 26. So the Nifty is 8.6 more expensive than it was in the previous market peak. So that's what's showing you about the FII inflows effect. The mid cap index 24, then 22 and a half now. So it's still not reached that peak, right? In fact, it is 1.5 below the peak. Small cap index, however, has gone 2.6 above the previous peak. So what does this mean? What this means is that if you look at the small table down below, is that while the mid cap and the small cap indices have risen, they are still trading at a 15% discount to the large cap purely from a valuation. Why do I say this? Is because the forward EPS is reflecting the forward earning expectation. But as you saw from the virtuous cycle of the previous, when the economy does well, the earnings of mid cap and small cap far outbeat the earnings of large cap. The market is not yet predicting that outbeat. It is saying that it is growing, but when the economic story turns good, you will see that these returns can scope up very, very rapidly, right? So that's where now I want to bring to you another thought process on where we are, right? Because of all the factors which have so far promoted the Indian stock market, what is the risk that we stand? As I showed you, valuations are all have risen above long-term averages and are close to or higher than the previous peak seen in December 2017. The biggest risk to the market is what can reverse all those factors. What were those factors, if you remember? Widening liquidity, second, widening fiscal deficit leading to weakening dollar and commodity prices dropping. That was all the news which was bad for the world but good for the Indian market. So naturally, if the good news on economy starts, fiscal deficits will contract, the dollar will start strengthening, and the liquidity tap will be reversed, and commodity prices will start rising. So all the factors, which is what I want to show you in this. So the risks on the horizon are dollar strength instead of weakness, a sustained rallying in commodity prices leading to inflation, and the US paring back their liquidity because of that inflation and growth supporting, growth going higher. They will focus on inflation. So this naturally for India will then translate into sharper rupee depreciation. And there's another reason why we expect the rupee to depreciate. I'll come to that. But luckily for us, bad monsoon, while it's a risk, so far the news is good. But commodity imported inflation, if oil prices rise, that imported inflation will come, and RBI will also be forced to shift its focus to inflation and pull back that liquidity they have done. So the clear risk factors are laid out here. And what is the probability of that happening? Let's turn our focus to the USA, because we can't keep studying every market, but the US is the most dominant market in our minds. So the key is on markets, inflation, and the Fed. What is they are going to do is the risk to the market, right? So there are three key layers to this narrative, right? The layer one is that the US has had a back-to-back stimulus. Savings of people have risen in the US, why I will show you. And they've also taken a number of steps to restrictions to remove so that consumption can boom. That's the layer one. Layer two is commodity prices rising, pushing up the input costs. The third is the supply bottlenecks and logistics, because as demand rises, will the supply be able to cope, and that bottleneck itself will lead to rising prices, right? This three clear layer narrative is what is there, because the markets have been discounting that the Fed, which had started the liquidity, was expected to provide $9 trillion of liquidity, and the expectation, as they said here, is that they will start tapering in Jan 22. Why is that? First of all, the growth in the US is expected to rebound. Driven by what? Driven by consumption. Consumption by whom? Consumption by the people, the taxpayers. Every single taxpayer in the US was given two checks by the government, a $1,400 check and a 600. $2,000 checks were sent, mailed to each taxpayer in the US. And during the lockdowns, they didn't spend the money. So all of this has led to a sharp jump in the savings, which will get translated now into consumption and demand, which can happen when the lockdown gets lifted and they start traveling, which is what the hotel occupancy rise. During the crisis, it had dropped to 21, then there was a crisis, then the second wave hit, again it dropped, now it's back to 60%. The pre-COVID level was 64% in occupancy. So it's almost there. So the US is recovering fairly fast. The second is, the fact is that the inflation risk will come because the labor markets have become tighter. Now you'll say why? Because most of the job losses which occurred during the COVID occurred in the low wage sectors on the left, 68%, whereas the middle wage and the high wage saw only 17 and 14. Why this is the case? Because there could be wage rises, so that a sharp rise in wage growth could lead to more money in the hands of the workers, but also inflationary pressures. And on top of this, because of this demand, the US real GDP relative to pre-recession path, right? It's 3% above the pre-recession path. So the US is recovering much faster in this crisis compared to all the previous crises, as I've shown you, right? So that is the biggest risk, because what that means is that when the US comes back to growth, is that the inflation will go up. Now, how to predict that inflation? There is a new indicator which I want to introduce you to. It's called the blue line, which is called the 5Y5Y. What is the 5Y5Y? It is a study of a 5-year average inflation over 5 years, and using that 5-year average to predict the next 5 years. Such an indicator has proved to be a wonderful predictor of inflation, because it moves very closely with actual inflation. And as you can see from the two graphs, the red graph is the CPI and the blue line is the 5Y5Y line. As you can see, it's clearly showing that US inflation is headed upwards, right? So the market metric has been indicating an inflation surge for a while. The same 5Y5Y can be used in other territories also. So next, the 5Y5Y is being used against the oil prices, the Brent crude. Can you see how the 5Y5Y indicator again moves closely with the actual Brent crude prices? And what it's telling you? It's telling you that oil prices are on the rising trend, as you can see. So it's the second indicator. So not only is overall inflation setting to rise, but oil prices are also setting to rise. As you'll realize from India's perspective, please put this in context. I will come to that. Third, we've used the 5Y5Y also in terms of the metals index. Metals are global cyclicals, as you're aware. Again, if you see the correlation, while the direction is the same, there was some disparity earlier, but right now they are moved very closely to each other. And so the 5Y5Y index is telling you that metal prices are also on the rise. So overall inflation, oil prices, and metal prices, all three are directionally higher, which means that a recovering US economy means fiscal deficit can come down, so the dollar will strengthen, number one. Second, price rise in the metals and oil is what? Is a commodity price increase, which means for a country like India, it is going to lead to imported inflation, right? The third is the CPI rising, means the inflation rising, means the Fed will start worrying about inflation and hence start that 5-letter word called tapering, pulling back the liquidity. So all the three risks that we see from the Indian markets are all in a present and a rising trend, right? And so why is the market bothered about this inflation? I just mentioned, right? If you see historically, 2002 to 2006, and if you see 1998 to 2002, the Fed goes through these liquidity boom bust cycles. So when do they start tapering? When inflation crosses a particular threshold, right? That's 2002 to 6 and 98 to 2001. And now that threshold has been reached, right? Therefore, the markets fear that this will happen now, the tapering will happen now, and that's the risk is on the anvil. But if you ask the market participants what their expectations of taper is, an opinion poll, 45% are saying that in October, November, December this year, tapering will happen. Another 16% are saying it will happen in January, February, March, quarter 1, 22. So 60% of the market participants are expecting in the next 6 months a tapering to happen. So this is where the market expectations of these risks are. But why were we worrying about it? Because I told you there are these related factors for the Indian markets. And if you see the US markets and the Indian markets, when you compare over a long time, move very closely. So this is 99 to 2009. Can you see the Sensex versus the S&P returns, the graph? This is from 2009 to 2021. Can you see how closely they moved, right? And when you take the last period, which I've expanded now, this is the period from 16 to 21. Can you see how the rise and the fall are going together? So any such withdrawal which affects the S&P returns will also affect the Sensex returns. That is why all of this tapering noise that is happening, while it's worrisome to the US markets, it also should worry the Indian stock market, right? But one final thing to say about this particular chapter is what finally matters is the what Fed thinks. And so far, the various chairmen of the Fed's committee, the board of Fed governors, have all been saying that they see that it is not the time that we are going to taper. We don't see. What they are saying is that the inflation which you see is transitory, temporary, transient, all kinds of words starting with T, all saying that we expect the inflation to drop. So when they are doing this graph, they are taking the rising inflation and then putting a dotted line to say inflation will come down. So we are not going to taper. So the Fed is talking market supporting language. So the markets have not yet reacted. So one hand side, the opinion of the market participants is that they will taper, but the Fed is constantly coming and calming them down, right? So ultimately what the Fed thinks and what the Fed does matters, but just take one fact. What the Fed says today is for today. Tomorrow, if the actual economic data, that is GDP growth data or inflation data, inflation at least they can say is transitory. But if they see the growth and they see the growth is not transitory, that the growth is permanent, the Fed will lose no time in just changing its speech and saying, I'm going to taper. So the question to ask is, when is the US recovery actually going to be so strong as to make the Fed change its talk? That to me is a time frame issue, and I think that it's a matter of max 12 months. Well, market participants may think 6 months, let's give it another 6 months. I believe that in the next 12 months, right, maybe 18 months if you want to stretch, the US is definitely going to show the positive effects of all the fiscal stimulus, all the monetary stimulus that has been put in. Because remember, in the US, Mr. Biden has come to power with both houses of parliament in his favor, the Senate and the Congress, right? So he's clearly on a growth path. As you know, he announced a 2 trillion package. He has now said that he'll make it 600 trillion package, but he wants a 1 trillion economic support bill to be passed. Only then he will pass the other bill. So 1.6 trillion in stimulus is going to happen. So US growth cannot be wished away. It is something that is definitely going to happen. It's a matter of when and not if. So my recommendation is in some way, one's portfolio should build the fact that sometime in the next 12 months, tapering is going to come through and impact the markets. Right. So overall, from an Indian markets point of view, while there are a number of factors to consider, the biggest concern for India is today commodities, right? Oil, metals, because we import them. The second biggest concern is Fed. So keep your eye out on these two in order to take a asset allocation call. That being said, right, I want to turn now, while I've highlighted the risks, that where there is risk, there is opportunity. And where does the opportunity come from? The opportunity comes from the fact that this rise in inflation. If you take the past track record of corporate profits in India and inflation, what we have observed is that when initially the inflation rises, corporate profits are seen to improve. So this rise in inflation in India, when it occurs, it actually could lead to a growth in EPS, thereby justifying the valuations that are undrawn. Why does this happen? Because that rising inflation, if it coincides with a rise in demand, they are able to pass on the input cost rise to the buying public, right? So as simple as that. So in our view, when this pent-up demand comes into play, and though the inflation may rise, they will be able to pass it on. And so from a stock market perspective, inflation and corporate profits have moved together in the early cycle of the recovery. That's number one. Number two is that still the COVID crisis may come, second wave, third wave, fourth wave, but ultimately as a nation, one day we will counter it. And if you then look at it and say, what is India? Right? As a country, we have several structural positives. And why is it important to focus on this? Because FII money, while some of it is dependent on this liquidity from the Fed, so that hedge funds can borrow from banks and invest in our markets to make a quick buck. The fact is there are also long-term investors like pension funds, which look at the longer growth story and say, I have to pay pensions 10 years, 15, 20 years from now. So I need to be in a place where growth is happening so that ultimately the stock market returns will match the economic growth and deliver those dividends to them. So that money, which is a significant proportion of the money in India, is not so sensitive to the tapering talk. In fact, might look at the tapering related correction as a buying opportunity. So it is important that we don't lose sight of that and think about what these long-term FPIs are looking at, and we then marry our portfolio call to that they will be taking. So there are three separate factors here. Housing sector is one, the PLI initiative is another, and the national infrastructure pipeline is a third. We'll spend a few minutes on each of these. So I'll start off with the housing. It's a very domestic scenario, driven by what? It's driven by the fact that RBI has brought down rates. Real estate prices have corrected and stabilized, are not rising because of the pandemic. And incomes of the middle class and upper middle class did not get affected in the pandemic. On the contrary, their consumer surplus actually went up because their expenditure on holidays and consumer durables, all of that came down in this corona crisis. So they are sitting on money. So overall, if you look at it and say that I have a home loan and I have an EMI, and what proportion of my income will go in EMI to buy a decent house, this number today is 27%. This number just a few years back, 10 years ago or 15 years ago, was at 58% of your salary. But 2003, which was the boom time, it was 27. So we are at that level of affordability which was in our boom time, which means that the housing sector is ready to create the next boom in our country. Why do I say this? Because not only do people use this to buy houses for them to stay, but they can buy houses to rent. Because when you rent, what happens? The income tax gives you a tax break on the rental income, right? From your interest that you pay, you can set off your rental income. So from that point of view, the post-tax impact of buying a house to rent out, the difference between, obviously, initially it doesn't fully cover it, right? The EMI was 7% that you have to put from your income to buy that second house over and above the rental income. Today, from 7, it has dropped more than half to 3%. If you put just 3% of the value of the EMI from your pocket, right, that differential, right, you will be able to buy a second house or a third house or a fourth house to rent it out, right? So this boom in the housing sector is going to have a capital multiplier effect in our country, because there are 10 to 12 industries which will benefit, starting off with the cement and the steel, obviously, the wiring, copper and aluminum wiring industry, the PVC pipe industry, the sanitary ware industry, the tiling industry, the woodwork industry, the paints industry, the real estate companies and housing companies, and the housing finance companies. So it has a very salutary effect on 10 to 12 sectors of the economy. So housing boom, when it takes place, it really creates a multiplier effect. So this is a long-term sustainable story for India, because the government is also with this Aadhaar housing for all goal by 2024, which looks unlikely, but whenever it occurs, is going to support this fully. So that's number one, a structural positive for India. The second structural positive comes from another country, from China. Why? The story in China is that because they implemented a one family, one child policy, right, is that their working age population has started declining, the red graph. Whereas India, its working age population is continuously rising, and till 2050, our working age population is going to go on rising, which means that from a labor supply point of view, right, China is losing its labor. So its ability to bid for labor projects and its costs have also gone up. Whereas India has a rising labor population. So any person wanting to set up a new factory in a low cost zone, who used to go to China, making China the manufacturing capital so far, is now looking outside China, and India has been in focus there because of our supply of labor. So we call this as the China plus one. So nobody is saying that they're shutting down their Chinese factory and putting up in India. It is having one more, because the COVID crisis also taught them that over dependence on China was not a very good thing. So this China plus one strategy has its base in this working age population. Now, India has to put itself in a right way to capture this. How and why? So first thing, this has to happen through foreign capital coming up and using India as a manufacturing destination. So when a foreigner comes and sets up a plant here, the taxation cost was one of the big deterrents. It was at 35%, right? By taking a bold step to reduce our tax rates to a half for a new company coming in to 17%, we have made ourselves the best tax rate country in the world, next to Singapore. Can you see 17% is our tax rate? Singapore is round about there. So this is one big step taken by the Modi government to make ourselves friendly to any manufacturer wanting to look at India as additional to China, number one. Number two, you have to make the conditions very easy, like licensing Raj going away, number of places that you need to go and tap for getting approvals, the road quality and the infrastructure. You set up a plant near the raw material, you got to ship it to the port or to the airport. How quickly can I get it? So these are the things that the government, through its infrastructure program, road, railways, has been working continuously for so many years. And so from 2015 to 20, over the last 5 years, you have seen that our ranks on ease of doing business has improved by 79 ranks. So clearly compared to 2015, we are in a much better position to be attractive to a foreign manufacturer. But is this improvement in ranks good enough? No. We have to improve further. That's where the second of my structural factors, the national infrastructure pipeline, comes into the picture. The government is talking of investing 111 lakh crores in the 20 to 25 period, focused on energy sector, urban roads and railways, so that our ease of doing business ranking can improve even more. How is this 111 lakh crore going to get funded? Budget wise, the government is spending only 5.5 lakh crores this year, right? It has to come from foreign capital. from sovereign wealth funds, from Japan, from Saudi Arabia, from Abu Dhabi. So we have to open up. That's where they opened up the infrastructure sector for FDI investment. And that you can see that India's gross FDI flows, right, have now gone up to 3.1% of our GDP, right? And last year we got $81 billion, which represents a 18% YOY rise in FDI. So the government's plans are already bearing fruit, and you are seeing increasing FDI coming in. In fact, if you take our competing entries and take over the last 2 years from 2018, second quarter, fourth quarter, we are that one country which has got a 22% per annum growth in our FDI, highest among the peers. In fact, a lot of our competing countries have seen a reduction in the FDI growth percentage. So clearly, the government's policies are working, and the NIP is meant to make this happen even more. So that's the importance of the NIP policy, because this FDI will come. There are three types of capex, right? There's a government capex, which is the NIP. There is a private sector capex in India when they expand, but with the COVID and the lockdown and demand cutting, our capacity utilization has gone so low that the private sector domestic will take time to build up fresh capacity. But the foreigners coming and using India to set up capacity is what the government is targeting next through the PLI scheme. What is the PLI scheme? Clearly targeting wherever China has got a hold. It's a production linked incentive scheme. What does it say? They have identified as some core sectors where India's labor advantage, India's land advantage, ease of doing business improvement, and the fact that government said in these sectors, if you come, I will allow you to come. Those who set up a factory here will get for 5 years 5 to 6% of the value they add. They take raw material from a country and make it. They take iron ore, make it into steel, make it into cars in the auto sector, right? That value addition, the government says for 5 years, I'll give you 5% cash incentive in your pocket. So that for the first 5 years, you don't worry about the profitability of your business. After that, from your profits, I will take my income taxes and GST collections, everything, and I'll survive. So this is a huge, going to be a boost for the manufacturing sector in India, and initially for the capital goods sector, because in setting up these plants, first FDI will come in. Then to set up these plants, you'll need cement, you need steel, you need capital goods, you need all kinds of things, right? Like what I talked about in the housing sector. So you are going to see a secondary and a tertiary boom in the capital goods and cement and building materials, which then will be followed by these plants actually manufacturing, making goods in India, and then what will they do with it? They will export it back to the US or to the Europe, right? So that's where, if you see in electronics, which was among the earliest where they did, already our electronics export share in imports has gone from 13% in December 17 to 24%, almost doubled, right? And in the case of mobile phones specifically, we have already increased our exports to more than our imports. So this is the goal of our country, that it is the old Make in India program didn't work with the weight. So the PLI combination with the NIP and that is going to ensure that India's labor supply is well used to become a manufacturing capital like China was, and give a boost to our export story. So the case obviously is that to support exports, the currency has to be supported, right? So this FDI inflow plus FII inflow, what it has done to the currency, if you see the first line, the USD INR, the Indian rupee has appreciated 3.4% in the last 1 year and only depreciated 2.2% over the last 3 years. Why do I point this out? Is that an appreciating rupee is not good for our exports, number one. Number two, the fundamental factor of the rupee is to depreciate. Why? That is what I mean by the PPP, purchasing power parity, or the interest rate parity basis. That is, between two countries, the currency rate difference should reflect the interest rate difference. So what is that? If you go down to the table below, you will see that the 10-year GSEC on June 14 was 6%, and the 10-year American 10-year was 1.5 roughly. So the difference is 4.5%. You take a number of points in the past, right up to September 2019, March 2019, you can see that it hovers some between 4.5 to 5.5. And go back up to the table above, what is the 10-year USD INR change? 4.9%. There is the evidence for what I'm saying, that in the long run, the difference in interest rates has to reflect in the difference in the currency's depreciation. So the rupee's short-term strengthening actually represents two things. One, the RBI has to allow the rupee to weaken over the medium term if they are serious about supporting exports, supporting the PLI initiative. There's no choice in the matter. Temporarily, there's $600 billion surplus is allowing them, because today we are worried about the cost of imports. But soon we have to switch our narrative to supporting our exports. So first is, I expect the policy itself to allow it to depreciate. Second is that the fundamental interest rate difference. Otherwise, RBI will have to narrow the gap by hiking interest rates, right? So that is the risk factors. So how much will they allow to do that? Because that will cut our growth. So in that balance, right, I expect that the rupee over the next 10 years will revert to that 5% depreciation. So this 3.3% appreciation today represents a buying opportunity for buying a story which depends on the rupee depreciation to help your portfolio. What? Obviously, you got to invest in the export related sectors, number one. But second, there is another avenue. What is that? Let's go back to the world for a minute to make this point. Remember that apart from the monetary stimulus and the liquidity, the fiscal stimulus, there was a medical response through vaccination by the world also, right? So 2.7 billion doses of vaccine have been administered by the world. And as a result of this, a number of countries have crossed the 40% to 50% barrier on at least one dose being given. Why do I point this out? Because that means that they're all that much closer to the growth path. They're covering at least 50% of their populations. India is way behind there. So Western countries are far ahead of us in terms of vaccinating their population, and hence that much closer to an economic revival, just like the US. The US itself here is in the middle at 52.9%, right? And hence global GDP, in addition to the US specific number, is set to overshoot the pre-COVID glide path. The yellow line was pre-COVID. What was the growth rate of the world that was expected by the IMF? What is the now growth rate expected? Can you see that that line is overshooting? That means the world is recovering much faster and going to be in a better state post-COVID than was estimated pre-COVID. This means what? This means that a global synchronous recovery, not just the US, right across US, Europe, Japan, China, everywhere there is a synchronous recovery, and by 2022, they're expecting almost 5% GDP growth for the world. So, what is the driver of this world? Because when the developed markets where the vaccination is very good come back to growth path, it's a demand driven growth path in the developed countries. Why? Because their per capita incomes are very high, their people are spenders, but they don't have the raw materials, people, supply factors they don't have. So their demand has to be supplied only by exports from emerging countries, right? So the export story of all emerging countries is going to grow depending on who builds the better. We are doing through the PLI. But more importantly, to cater to this growth, there needs to be capex, right? That's what this graph is showing, right? Emerging market exports, which are naturally to the developed markets, and their capex move hand in hand. So not only are you going to see an export growth from emerging markets, you're also going to see a capex cycle in the emerging countries. India is also a part of that, but I'm just pointing out to you today now the context that the world growth is not just a US story or a developed market story, it is a worldwide story of growth. What do I mean by that? Is that even if this tapering occurs, the impact of the tapering today compared to 2013, where I've shown 2013 how deep the correction was. Why was that? Because the current account surpluses then were in close to deficit or just about surplus. Today, the current account surpluses are very, very high. Means ability of these countries to absorb a tapering and related inflationary shock is much better. Hence, this time the tapering, while it will have its effect, overall in the emerging market, it's expected to not have as strong an effect, which is positive for their economies. Hence, there is a case not only for an export-oriented story for India, but a case for investing in a diversified portfolio of international equities. Why do I point this out? Because growth is going to happen in a lot part of the world. So that growth is something that you can participate, and the vanilla on top of the cake is what is the fact of the rupee depreciation. Any portfolio of international equities that you invest in, we have a global brand fund that will benefit from the expected depreciation of the rupee, right? So a rupee which has strengthened the last 1 year represents a buying opportunity for you in a mutual fund of diversified international equities, because the growth of a diversified portfolio in the countries in addition to the rupee currency means that they are an excellent addition to your portfolio at this point in time, right? So to come to my final slide on how do you so I see the asset allocation. So what I've tried to do is I've tried to put a moderate risk return investor in the middle of my chart. So you can take a call on an aggressive versus a conservative, how to tone it down. So what I believe is, let me start from the right. I just talked about the global story. I believe for a moderate investor, 20% of the portfolio allocation to a globally diversified. I would not recommend you to choose sectoral global funds nor country specific global funds. Choose a diversified portfolio across international, put 20%. Put exports, which I consider to be defenses today, because they are your counter to a rupee weakening, right? So they are essentially defensive today to what is going to happen. I would say 10% of your portfolio, try to put it in export-oriented sectors like IT, pharma, and the like. Fund managers will do it. So you take a call on your portfolio, how much that mutual fund has already got in these defensives, and you taper it down. Now moving to the left, I would say that mid caps, because of the position they are in relative in valuations to large caps, and because large caps are the ones which will get immediately affected by tapering news and the noise, I would say that mid caps from a valuation perspective are in a sweet spot and should be the largest part of your portfolio at 30%. Keep 20% in large caps, because large caps will also have a diversified portfolio, and accordingly the composition of large caps from an FMCG towards this will be changed by the fund managers. So 20% is a good allocation to have. Now I come to the bottom left. I say small cap 10%, right? I say domestic infra 10%, because that whole PLI, NIP housing story is something that Indian GDP will grow in. While there will be a reaction to tapering in the mid cap and the small cap and the infra space, because they are all what liquidity made them rise so much, that drying up of liquidity will make them fall also, right? So it is going to be a volatile period. However, at some point in time, this tapering will be absorbed by the markets, and the focus will shift on the India growth story, which is when they will start their next rise. So you should remain invested at least to the extent of 20% across small cap and infra. See, small cap index is 40% infra, and infra funds are all 40% small cap. So roughly they are overlap with each other. So 20% to small cap and infra will give you that ability to capture the wealth creation over the medium term. So for a moderate return investor, doing a portfolio like this is my recommendation. Thank you very much for patient listening.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.